Nouriel, you are known for forecasting what others don't see. Last year it was the sovereign debt crisis. So what is the one thing this year that next year at Davos we will be saying Nouriel predicted this? What could throw us off course in this recovery?
Well, there are many things that could go wrong in the global economy, but among the new risks as opposed to the old ones, Eurozone trouble, I would say that there is now this significant increase in oil, energy, food prices. It's problematic, I would say, for three reasons. One is leading to a rise of inflation, especially in emerging markets that are overheating. Secondly is a negative income effect for all the commodity importing countries, so it could reduce consumption and growth in advanced economies. And three is leading now to social and political instability. What has happened in Tunisia is happening right now in Egypt, but also riots in Morocco, Algeria, Pakistan are related not only to high unemployment rate and to income and wealth inequality, but also this very sharp rise in food and commodity prices. So it could be a source of actually political instability, not only economic and financial fragility.
And what will be the broader effect of that, not just on those economies, but on Europe, for example, that is still very much trying to get on its feet, and on the United States?
Well, everything else equal, I would say that in advanced economies, I worry less about the effects of these rising prices on inflation, because you still have a slack in goods and labor markets. But in emerging markets, it's going to lead to inflation. But in advanced economies, a negative tax on income is a reduction in the real disposable income. It means less consumption. If gasoline prices were to go towards $4 a barrel, you could have a retrenchment of consumption. They're going to slow down economic growth.
We've been there before, not long ago.
Yeah, if you think about it, when oil reached $148 a barrel in the summer of 2008, that was the tipping point for the global economy, led to a global recession. It was not just the effect of Lehman. That rise in oil and commodity prices led to a significant negative effect on income and spending in U.S., in Europe, in Japan, in China, in India, and all the net commodity importers. So this is certainly a new risk.
What about overheating emerging economies? You talk about inflation a lot. Let's focus on China, because there are some, not the majority, but some like Jim Chanos that argue China's overheating. It is not going to see a soft landing. Inflation is a bigger concern there than the politicians and regulators are paying attention to. Your view?
Yes, I don't worry about, like he does, about the immediate crash of China, but certainly economic overheating, growth of 10% or above, rising in inflation, credit growth has been excessive, fiscal stimulus, asset bubble, especially in commercial and residential real estate, and China has been behind the curve in terms of monetary tightening. They've done it too little compared to what they should. The risk is now inflation might get out of control. They might have to tighten more than they wanted this year. And every time China tightens, the effect on equity markets, not just in China and Asia, but globally, is significant because people worry this is not going to be a soft landing. It could be a hard landing. I don't think that China is going to have a hard landing, but certainly this trade-off between maintaining high growth and controlling inflation is going to be a serious policy challenge.
So how great is the risk in China, and how far off is it?
Well, the big risk right now is that inflation is really rising. It's becoming a social and political question, and they've not, on one side, tightened monetary policy enough. They've maintained high credit growth, and they've not even allowed the currency to appreciate, because one way of controlling inflation is to have a stronger currency that reduces import prices, because they don't want to lose competitiveness and trade and exports. Sure. They're not doing that one as well. So they're pushing the problem down the road, and the risk is that then when inflation really rises, they'll have to tighten much more in the second half of this year, and it could be something dangerous for growth.
Focusing on the U.S. economy and the U.S. jobs picture, that was the focus of the State of the Union. Your jobs outlook for the United States?
I expect that the U.S. is going to create about 150,000 jobs per month this year, but 150 is just the increase in the labor supply, so it's not going to lead to a significant reduction in the unemployment rate. So the U.S. is going to grow maybe close to 3%, but we're going to have still high unemployment rate. The housing market is already double dipping and prices are falling. We have the state and local government problem, and we have the federal deficit problem.
Just breaking that apart, the jobs crisis, unemployment above 9% for how much longer?
Well, we had to create something like 250,000 jobs per month for the next 3-4 years to bring back just the level of employment to what it was before the recession, let alone create net new jobs.
So years ahead.
Years ahead, absolutely. Unemployment is going to remain a significant problem for the U.S. economy for many years.
And you said we're already in a double dip in U.S. housing?
Yes, if you look at what happened, we artificially boosted demand through the tax credit. Once it's expired, demand fell, and now there's a pipeline, a shadow of millions of homes that have not been foreclosed yet. There's going to be foreclosed. So supply is increasing, demand is falling, prices based on Case and Shiller are already fallen every month since August. That means more people that are in negative equity, more people living away their homes, negative wealth effect. So the housing market is already in a double dip.
And then couple that with the crisis of the states and state budgets. How severe is that crisis?
It's a serious one. Europe has the problem of Greece, Ireland, Spain, Portugal.
We have California and Illinois.
Absolutely. And, Greece is only 3% of the Eurozone GDP, while California alone is 1/7 of U.S. GDP. And as you point out, is California, Illinois, Nevada, Arizona, New York, and other states. So those fiscal problems are severe in the United States at the federal level, at the state and local level, and there could be disruption in the municipal bond market. It's already putting upward pressures on those interest rates.
Nouriel, your take on the President's State of the Union address. Specifically, he addressed the deficit and what would be done to cut the deficit. You're skeptical.
I'm skeptical. It goes in the right direction, but I'm skeptical for two reasons. First of all, his proposal on corporate taxes may be good in the sense of reducing loopholes, having greater base, and reducing the tax rates, but as he says, it's going to be revenue neutral, so it's not going to affect the deficit in terms of reducing it. And on the spending side, everything is proposed, like freezing discretionary spending for the next 5 years, is going to reduce the deficit by about $1 trillion over the next 10 years. That's only $100 billion a year in a situation in which the deficit is about 1.3 trillion. So, no, it's not going far enough. You cannot tackle only discretionary spending. You have to reduce also defense spending. You have to do reforms of entitlement. And eventually, we'll have to raise taxes. Taxes on the rich, taxes on the middle class. If we don't want to raise income taxes, we'll have to introduce maybe a VAT, a sales tax, or a carbon tax or something else. But we need to raise revenues because we're not going to be able to reduce this deficit only on the spending side.
Imagine the reaction of Americans to a VAT.
Yeah, politically, each one of these choices, whether it's a gasoline tax or a VAT or other types of taxes, there is still resistance to any tax increases.
We need more taxes, bottom line?
We do, because we're not going to be able to reduce a budget deficit 10% of GDP only by cutting spending. Of course, we need to cut spending, but now revenues have fallen from 20% of GDP down to 15%, while spending went from 20 to 25%. So the gap has to be bridged both on the spending side and on the revenue, but politically, speaking about raising taxes is not something no one wants to talk about. Not the Republicans, not the Democrats, and what they've just done is another $900 billion tax cut for the next 2 years. That's all paid with more public debt, another $1 trillion budget deficit. So again, you're kicking the can down the road, not taking the tough choices.
Sounds like the U.S. and China are doing that in different ways. Nouriel, thank you.
Pleasure being with you.
Thanks so much.